Canadian real estate is showing losses worse than the 1990s crash, as some properties down 45% in nominal terms. The first wave of pandemic-era buyers are hitting their mortgage renewals right now in 2026, and a little-known clause in your mortgage agreement means your bank doesn't have to let you renew at all. Welcome to the Daily Brief, Canadian Macro. I'm Steve. Today we're covering Vancouver's record foreclosures surge from Steve Saretsky, the deteriorating national housing picture from Mania and Butler, and a warning about U.S. debt dynamics from Brett Heath on the David Lin Report with real implications for Canadian rates and the dollar. Let's start where the pain is most visible in Vancouver. Steve Saretsky is documenting record stress in Vancouver's housing market. March home sales hit 20-year lows with zero pickup in volume despite last year already being a 25-year low for annual sales. The market is sitting at 7 months of inventory, well above the 3 to 4 month range for balanced conditions, and prices are down 7% year over year broadly, with condos in secondary locations like Gastown off over 10% with very little liquidity. Foreclosures have spiked to nearly 350 units, approaching the 2012 all-time high of 363 units, as renewals hit record numbers and some buyers face payment increases of 30% or more. Worth noting, developers are also sitting on 11,000 unsold condos as shadow inventory not listed on MLS, and factoring in BC's pre-sales assignment market, the true supply overhang is likely even larger. Vancouver is the canary in the coal mine. Now let's zoom out. Market Mania is documenting losses worse than the 1990s crash in some markets. Hamilton properties are showing 45% losses in nominal terms, or 60 to 70% in real terms, as Market Mania points out, once you factor in inflation. It is, however, important to remember that your mortgage balance is in nominal dollars, so the nominal figure is more relevant, but either way, the numbers are severe. Market Mania also flagged a mortgage clause many homeowners don't know about. Standard agreements across virtually every Canadian lender state that renewal is at the bank's discretion, not a guaranteed right. However rarely invoked under normal conditions, banks do want performing mortgages and not houses, but it becomes live when a borrower is in negative equity or behind on payments. The critical timing: 2021 buyers with 5-year fixed term rates are renewing right now in 2026, with the 2022 cohort following next year. For those already struggling with their mortgages, licensed insolvency trustees are already hearing, "I paid $1 million for this house, and it's only worth $800,000 now," on a daily basis. Butler from Angry Mortgage joins the chorus and confirms that 2025 and 2026 are the two biggest back-to-back renewal years in Canadian history. So the stress Vancouver is already showing is about to scale nationally. What Butler is also preparing mortgage professionals for is the cliff that follows, a dramatic drop-off in renewal volumes in early 2027 as the pandemic origination boom exhausts itself. If you're approaching renewal, it's also worth knowing whether your mortgage is CMHC insured or uninsured. The two have meaningfully different renewal risk profiles, and that's a conversation worth having with your broker now, not later. On rates, Butler flagged oil as a wild card that could force the Bank of Canada's hand, and that risk has arrived. Brent crude is above $110 US per barrel today, up roughly $47 from a year ago, driven by Strait of Hormuz disruptions and the Iran conflict. For Canada, higher oil is a double-edged sword. Energy revenues rise, but so does inflation, which complicates rate cuts at exactly the wrong moment for hundreds of thousands of renewing homeowners. Early in the Iran conflict, however, it should be noted that bond markets appeared to be pricing in up to 3 potential rate hikes starting in the fall. However, recent Canadian jobs data has caused this narrative to change, and since last week, the bond market is now showing 2 potential rate cuts coming this fall instead. Brett Heath on the David Lin Report makes the case for an impending soft default on U.S. debt. U.S. gross debt hits $40 trillion within 2 years, generating roughly $2 trillion in annual interest at 5% borrowing costs, forcing shorter-term refinancing cycles that compound the problem. He sees central banks globally rotating out of U.S. treasuries and into gold, with around $9 trillion in foreign-held treasuries at risk of migration. He cites Tether as a notable example, though their figures are self-reported and hard to independently verify. His thesis: gold is pricing in problems 3 to 12 months before they surface. For Canadians, however, a softening U.S. dollar matters beyond gold. It erodes the value of U.S. assets you may hold in your investment accounts and pushes up the cost of American imports, which filters through to everyday prices here at home. The through line across today's analysis is straightforward. The relief valves are closing. Rate cuts are complicated by $110 USD per barrel oil. The 2021 renewal wave is here, and with 2022 right behind it, Vancouver's foreclosure surge and collapsing sales volumes may be previewing what other Canadian markets may face over the next year. On the opportunity side, both Market Mania and Steve Saretsky flag motivated sellers in foreclosures and estate sales as worth watching. And Market Mania notes that sticking with your existing lender at renewal can help you avoid a fresh appraisal that might expose negative equity. Well, that's your daily brief for today. All credit goes to the creators featured. Their original analysis and videos are linked in the description below. If you found this video helpful, please subscribe, hit the notification bell so you don't miss tomorrow's brief, and don't be afraid to comment if there's another creator you think deserves a highlight here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.